Good afternoon. Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth, with you this afternoon on the 20th of December, right before the holidays and the new year and all things exciting. And wanted to spend a few minutes with you to sort of put a wrapper on the year and the month and to say, give you a sense of what we're thinking here at ALINE Wealth and what's happening in the markets, the conditions, and what we're seeing economically as well. So allow me to share my screen and we will proceed. Okay, so the title of this afternoon's talk is a soft landing a done deal? Or otherwise we could call it, will the ghosts of Arthur Burns come back to haunt Jay Powell? Arthur Burns was the Fed Reserve chief back in the 70s, and he was known essentially as a flip-flopper in the sense that he would be dovish, then hawkish, and then dovish and hawkish, and essentially that non-resolute behavior as it relates to monetary policy may have been, as some say it was, the reason why inflation was not easily contained back in the 1970s. So let's see. Okay, so where are we? Our take has not changed very much. We believe that there has been a regime change, an economic change. After 40 years, markets have been buoyed by ever lower interest rates. The cost of money, right, has gone lower and lower, which has provided a huge wind at the backs of investors, speculators, consumers, buyers of all kinds of goods. So we see that, and we've seen that, and now we're saying that perhaps something has changed. Inflation allowed, or disinflation at the last 40 years up into 2020, had allowed this reduction, this consistent and constant reduction in interest rates. But we believe that there were extenuating circumstances, a confluence of issues and elements that caused this disinflation: globalization, the collapse of the USSR and flooding the world with commodities at that time. Certainly technology was a massive disinflation agent, as was immigration policies. These are the things that we do not have today, as we'll see in a moment. But going to the new regime, we no longer believe that wind is at our backs. We believe higher for longer, or at least persistent, sticky inflation. We don't believe we're going back down to the extraordinary low interest rate environment of the last 15, 20 years. Here's a little bit of a tidbit. If you were to think about the average Fed funds rate between the years of, say, 2011 to 2020, what would you think it would be? And if you probably wouldn't say 0.5%, but that was what it was, 0.5% on average over that period. We do not believe that is ever repeatable. Ever is a long time, but in our lifetimes, and therefore, with the normalized interest rate environment, and we are more normal now, there are implications for investors, and we are looking to unpack those. So things are changing. Now we have deglobalization. Again, that is an inflationary agent, not a disinflationary agent, with the near sourcing that is caused by deglobalization. Labor strength, you've seen the strikes, you've seen what's happening out there. And again, it's not my job to opine on the good or bad of that. It's simply to say that it strikes me as being inflationary. The ESG mandates and the decarbonization standards, they certainly impact supply of materials and the costs of those materials. So bottom line is, we believe that we're going to be more of a market that's less momentum based and more focused on fundamentals and stock picking and doing the hard work of security analysis. This slide really sets it up very nicely. Thank you to our friends at Strategas for this. If you look back in the 45 to, I guess, 82 period, you saw a 36-year period where the S&P had grown at a roughly 5.7% on average. But you also saw, as indicated by the blue line, an increasing 10-year yield throughout that period of time, topping off at the 15 or so percent in 82. And then, of course, the massive growth that we've seen in bonds and since then, that 40-year period we had mentioned, the old regime. Look at the CAGR. Look at the S&P 500's growth rate in that period of disinflation and lower interest rates. Double, if not more than double, what we get in the prior period. It just strikes me as interesting that folks are believing that we're going back to this world again, and I think we're more likely to be in this world for a bit. But that's the S&P. There are ways to do better, as you will say. Okay, now part of all this is the inflation backdrop, and I know since November and the Fed FOMC meeting in the last few weeks, there's been talk about the interest rates coming down precipitously and inflation going back down. We're on the other side of that. We don't think that inflation is going to come back down that dramatically. Look at this slide, guys. The previous periods of U.S. inflation, 10, 39, 72, and 21. And as you can see here, we often have this scenario where we have a first leg up, it comes down, it goes back up again, right? The same thing happened here in the 70s. Inflation picks up. This is the Arthur Burns period. Down, up, down, up. So the idea that we vanquished inflation, put the genie back in the bottle in one cycle is just unlikely in my view. I think it's more likely that we're going to be battling for the reasons I have mentioned, I have laid out, that will cause a persistency and a stickiness with inflation going forward. Here again, we see the same thing in the past, previous inflationary periods, and this one. So the fact that we've come down fine, I just don't think the inflation game or the inflation genie is back in the bottle per se. And part of the reason why, besides the deglobalization and nearshoring, the labor ascendancy, is this issue of the build out of net zero, right? The net zero movement, the 2050 goals, all needed, okay, but will be inflationary. It's just no way around it. We have not invested in the supply of these critically important metals and materials, and therefore now, as we begin demand ratcheting up for these, there's going to be a fair amount of push inflation throughout the system, and that's going to, certainly be something that's not going away anytime soon, and is likely to be a drag, or I should say, a push up on inflation. Now, let's talk about some market internals. Okay, so we just gave you a macro picture with inflation and our view there. Now let's talk about the market internals. Concentration risk. Folks, come on, this is telling, we see what's happening here. And when you see this kind of activity where you're 2 standard deviations above the mean, this is technology versus the S&P, you got to sort of think about watching out and being careful, all right? Same thing here. Top 10 stocks in the S&P make up 35% of the index. When has it happened in the past? Oh, right before, before the market came down in 2000. So history may not exactly repeat itself, but it often rhymes. This is a flashing yellow light. We need to be cautious and aware of this. But again, that's the top 10 stocks in the S&P 500. That is not the investment universe. Our job is to look through that investment universe, to scour it in search of the best priced investments that meet our clients' mandates. Now, I want to unpack this for you because I want you to think about this logically. Equity risk premium. The way they're showing it here is interesting. The reciprocal of the price to earnings ratio is essentially a yield. Think of it as a yield, like a bank account yield, a bond yield, on the price of the S&P, right? The earnings over the price. And that's the yield you're getting from the S&P 500 if you're looking at the earnings yield, okay? Minus from that earnings yield, the risk-free 10-year, right? That's the risk-free rate. That delta, that difference would be the equity risk premium, essentially the premium you're going to get by investing in equities versus the risk-free rate. And as you can see, that premium is near zero, if not zero. That's important because you typically do not want to buy stocks when they are when the equity risk premium is low, but rather you want to buy stocks when the equity risk premium is high. And so this is where you get the best bang for your buck. You're able to get as much return for the risk you're taking. And at the end of the day, it's all about return versus risk, right? So I would say here, at least with respect to the S&P 500, you see what I'm saying here, it's not just the S&P 500, but in this case, looking at the S&P 500 and it's overweighting to 10 stocks, you've got a situation here where you're not getting paid to take on the equity risk the equity risk. Price to earnings multiple, PE for the US market. Again, when you break it down, you have the magnificent seven stocks trading. Here you see at 35.4 times. This is 2022 to 2023. So check out that growth in 1 year. In 1 year. Now, 22 was a difficult year. I get that. But despite that, massive increase in the multiple. That is not necessarily the earnings, the multiple. Okay. Now, look at this. Even the US market X without the Magnificent Seven from 22 to 23, that multiple has expanded 170 basis points, despite increasing interest rates the whole time. So, this strikes to me as being maybe a potentially a little irrational exuberance here. Okay, so with that backdrop, what are we doing? Overweighting cash, respecting volatility. Let's face it, cash, it provides us with two things: a ballast to the portfolio, doesn't go down. Number two, it provides us optionality so that we could utilize that capital when markets are in stress and we find opportunities that are on our buy list that we have done robust research on, and now we can pick off these investments at lower prices because we have the cash on the sideline. We call that dry powder. So having that overweight position, and by the way, we're getting paid for it now, whereas a couple of years ago we were getting nothing. That's number one. Number two, fixed income is just not the ballast it once was. We need to be cautious. I know we've had a huge bond market rally in the last 6 weeks. We're not sure that is sustainable. We do like very much dividend growth companies with dividends and companies that are growing their dividends. They're cheap, as we'll see in a moment. Value style, we'll see why. And of course, the old standby of free cash flow yielders. All of those are important parts of our screening process when we do our work to find investments that matter for our clients. We also like real assets, infrastructure, resource companies, inflation-centric asset classes, royalty companies that have very high operating margins, companies with pricing power, and the water sector, which is a favorite of ours. Now, just some level setting here. We are not traders. We are not buy and sell guys per se. We are compounders over time. Yes, we're overweight cash now because we see opportunities will be better down the road, and therefore we want to keep some money in dry powder. That's not the same thing as timing. That's just being value centric. What timing is all in and all out, and that's not what we do. We keep a balanced book. And this slide shows you that if you were, all out, or you're trying to get all out, and then you happen to miss, the best 50 days out of, whatever, the 30 years here, your return was dramatically impacted. The thing is, you don't know what those best 50 days will be when you're all out, right? So being more balanced allows us to keep capital working, maybe not all of it because we're balanced, but at least some of it. This is the same kind of scenario, but with dollars. All the days, $10,000 and the S&P grows to almost $1 million. If you miss just 5 days, and again, you don't know what those 5 days will be, you're down 38% from that level. Huge. 50 days, you're down 93%. So where are the opportunities hiding? What do we like? Cybersecurity is one sector we've liked for some time now. Frequency and severity of cyber attacks, they're up 2x in 1 year, and they're becoming more sophisticated. The cost of cyber crime is increasing, expected about a 15% CAGR for the next couple of years. Bad actors are increasingly destructive. They're coming after meatpacking companies and the Colonial Pipeline issue, water plants. So a lot of money needs to be spent, and that's the thing that drives cybersecurity. You have regulations and compliance, executive orders. We have a model of that we invest in, a model of companies that are in the cybersecurity field. Also, like liquid infrastructure, these are companies that are backbone assets to supply and support essential services. Think of long-lived assets like wireless towers and satellites and utilities and toll roads, water utilities. These are high barrier to entry companies and with an inelastic demand. No matter what the price, the customer has no alternative. They're going to pay. You need water, you're going to pay for the water. And predictable cash flows with inflation riders. That's big. We also see opportunities in value and especially small cap value. This is this shows you small cap value are the only indices cheaper than their historical. So the historical is here, 15x for the Russell 2000, and it's now trading at 14.8. And the Russell 2000 value, 14.9, now trading at 13.7. In every other case, you see the current above the 25-year average. So you're paying up, but you're paying up not in a zero interest rate, old regime environment. That game is played. You got a new environment here. It's 5%, Fed funds rate or more. Now, maybe it comes a little lower. We'll see. But bottom line is that this seems to be a little bit irrational exuberance given the 25-year average, given where we are in the economic cycle. Small cap value stocks also traded a large price to book discount versus U.S. large cap growth stocks, which historically it's boded well for small cap value. Same kind of thing here. Now, this slide shows you two factors, both the value factor shown by price to earnings ratios here, and then the dividend factor. So let's look at dividends. What this is saying is that the high dividend stocks, those that have a yield greater than 3.6, or we'll just go here, 2.3 to 3.6 or more, they were down in 2023, right? And their forward PE ratios are lower compared to up here. So the companies that have no yield, no dividend, they're the ones that jumped. They also got creamed in 22, so maybe that's part of it. But they're also trading at rich multiples. Same kind of thing. Those companies with PE ratios below 15.2 were barely up in 23. Those that have a greater price to earnings ratio of 26, we're up big. There's your Mag 7. And then here again, you're seeing the higher valuation on the growth side and value being close to its long-term average. And we want to buy things when they're cheap. You don't want to chase investments. Now, here's a story that is interesting, and I thought I'd break it down for you. When we've had concentrations like we have seen in prior instances, the Nifty 50 in the 70s, you had 23% of the 5 stocks, right? And made up 23%. In the tech bubble, the 5 largest stocks in the S&P were made up 18%. Today, it's almost 25%. Now, what happened in these prior 2 instances of concentration? Well, from that peak, we saw a decline of that relationship, that concentration. But more importantly, we saw a decline in the S&P relative to the lowest PE stocks, the value stocks. They did very well. Look at this. So, here's the S&P over those 5 years when we saw this concentration start, right? Here's the S&P up about 4.3% annualized for 5 years. And here's the lowest quintile of S&P stocks by PE, ergo the value stocks, up 21% on average. So when you see concentration, ergo bubble, you then see value shine. Happened again in 2000, right? You had the concentration in the tech bubble. You had an S&P that was down. Remember the lost decade? Well, for these 4 or 5 years, the S&P was actually down 2.3% on average. If you had owned the value stocks, which of course nobody wanted in 2099, they performed phenomenally over those 5 years, up 17%. I guess what I'm suggesting is that now that we are at the highest for 40 years in concentration, I would tend to think the next few years value will have a strong growth period. International and emerging markets are cheap. You see these valuation statistics here and how they are below average and therefore cheap versus the US. This is why we are allocating more capital internationally. Now, lest you think all is great, and it's a sort of a balanced approach here, I want to give you 2 slides that sort of sum up, I think, the future years here. This is exciting. This is the American tailwind. Look at this. I mean, for 50 years, I did the math, by the way. If you do the math, it comes out to about a 7% CAGR for over 50 years. What a wonderful country of household wealth growth, right? And that's why America's why we are the envy of the world, and for other reasons as well. But with respect to household wealth, it's a nice tailwind. And who knows if that continues at the same rate, but I would never bet against America. And so it's likely there is some growth here. However, we got a problem. And I've spoken about this time and time again. We have too much debt, period. That's it. 34 trillion, and it's not stopping. $2 trillion of deficit spending. This is an issue. I mean, I can't say it any clearer than that. I believe this might very well be the next financial crisis. Now we have interest rates that are higher than where they were in that old regime period. And now funding this deficit and this debt has become much more expensive. So these are the issues we have. And this is the concern I have going forward. This is why a balanced approach is the best way to go. I want to thank you. I want to wish you all a very happy and healthy holiday season, as well as a happy new year, and look forward to chatting with you. If you have anything that you need to speak to us about here at ALINE Wealth, we're here to help. Have a great year and a great day and great holiday. Thank you.